Ever wonder how a massive company hires the very people who are supposed to scrutinize its every single financial move? It's this super important process full of checks and balances that most of us just never get to see. Well, today, we're going to pull back that curtain and break down exactly how a company's financial watchdog gets its job.
All right, so to see how this all plays out, let's follow the story of a fictional company we'll call TechVision LT. Now, they're facing a problem that, let's be honest, every startup dreams of having. They've become almost too successful. And when I say successful, how successful are we talking? We're talking $50 million in annual revenue. And once a company starts hitting numbers like that, especially with public investors involved, the whole game changes. The law literally steps in and says, hey, you can't just mark your own homework anymore.
And that leads them to a whole new business challenge. See, this isn't just about crunching numbers. It's about public trust and, frankly, legal responsibility. TechVision is now required by law to have an independent external audit to prove that their financial statements are fair and accurate.
Okay, so the company's board of directors, they've got to get to work. Their first big task, and you could argue it's their most important, is finding the right firm for this job. The hunt for their financial watchdog has officially begun.
So, first thing they do, they draw up a short list of potential candidates. You can really think of this like a high-stakes interview process. You've got the big players in the industry, all serious contenders with great reputations. The big question is, who's the best fit for TechVision?
But here's the thing. This isn't just a few friendly phone calls. This whole formal search actually has a name. It's called the tender process. The board sends out something called a request for proposal, or an RFP, to these firms. It's basically a fancy way of saying, all right, show us what you've got. Give us your best pitch.
So, to see what this looks like from the other side, let's zoom in on one of these firms, ABC Audit LLP. They get the request, and their team gets right to work putting together a super detailed proposal. It outlines exactly how they'd go about auditing a company the size of TechVision. So, what's actually in one of these proposals? Well, first things first, the price tag. ABC Audit estimates that this job will cost TechVision $120,000. Now, that fee covers all the intense work, the expertise, and the resources they need to do the job right. Then you've got the timeline. They're projecting that the entire audit, from start to finish, will take 4 pretty intensive weeks. That's a full month of deep diving into every corner of the company's financial records to make sure everything adds up. And of course, it's not just about time and money. It's about people. ABC proposes a team of 7 professionals. You've got 1 senior partner overseeing the whole operation, 2 managers handling the day-to-day, and 4 junior auditors doing that critical, detailed groundwork. The proposal looks solid, right? The price is clear. The team is set. It seems like a go. But hold on. Before TechVision's board can even think about saying yes, there is a massive, non-negotiable test that ABC Audit has to pass. And that entire test boils down to one single word: independence. The auditor has to be completely impartial, totally objective. They can't have any kind of relationship or financial stake that could possibly cloud their judgment. Their only loyalty is to the facts. Look, this isn't just some corporate buzzword. It's the absolute bedrock of trust in the financial markets. Without it, everything starts to crumble.
And this is what that actually looks like in the real world. Over on the right, you see the major red flags. Does the audit partner personally own shares in TechVision? Oh yeah, that's an automatic fail. Is the audit partner's brother the company's CFO? No way, definite fail. Does the firm also make money by providing consulting services to TechVision? That's another fail. The firm has to be totally separate to guarantee that objectivity.
So good news for them, ABC Audit LLP passes the independence check with flying colors. So now the board of directors can finally make its official recommendation. They've gone through all the proposals, they've checked for conflicts of interest, and they've made their choice. So they write up this formal recommendation that's going to be presented to the company's true owners. It sounds pretty final, doesn't it? You know, like the decision has already been made. But wait a second. Let's really think about this. The board of directors, the very people running the company, do they really get to have the final say on who gets to audit them?
And the answer is a big, clear no. The ultimate power doesn't lie with the management team. It belongs to the actual owners of the company, the shareholders. And this is a fundamental rule of good corporate governance, designed specifically to prevent this kind of conflict of interest.
And that brings us to the main event, the climax of this whole process. The board's recommendation is now taken to the Annual General Meeting, or AGM.
This is where the company's owners, the shareholders, get to have their say on all the major decisions.
This really breaks down that chain of command, right? The board does all the homework, they vet the candidates, and they propose their top choice. But at the end of the day, it's the shareholders who cast the deciding votes. Management proposes, the owners approve.
So at the big meeting, the resolution to appoint the new auditor is put on the table, and the shareholders cast their votes. The majority agrees with the board's choice, and the motion passes. And just like that, with the democratic process complete, ABC Audit LLP is now officially TechVision's new auditor. To make it all official, the appointment is locked in with a formal contract called an engagement letter. This is what kicks everything off. And this line here is so important. It's a legally binding promise to do the audit according to global standards of quality and integrity.
Okay, so TechVision has its auditor. Case closed, right? Well, not quite. What happens next year? Or what if a company is brand new and hasn't even had one of these big shareholder meetings yet? Yep, the process has answers for that too. If it's a new company, the directors can pick someone to get things started, but only until that first big shareholder meeting. And this isn't a one-and-done deal. Every single year, the shareholders vote again to either reappoint the same auditor or bring in someone new. It keeps everyone on their toes.
All right, so let's just do a quick flyover of that entire journey we just followed. It all starts when the company gets big enough to need an audit. That kicks off the search and the proposal stage. Then comes that absolutely critical independence check. After that, the directors make their recommendation, but the shareholders get the final vote. And finally, the auditor is officially appointed, and the real work can begin.
And all of this brings us to one big final question. The watchdog has been hired, the process looks great on paper, and all the official boxes have been ticked. But does this whole structured journey truly guarantee bulletproof independence, or does it just guarantee the appearance of it? That's definitely something to think about.